Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Comfort Systems USA Inc. quarterly report. Comfort Systems USA Inc. offers a wide range of services to various industries across the United States. The company's services include mechanical installation, renovation, maintenance, repair and replacement, electrical installation, renovation, maintenance, repair and replacement, heating, ventilation, and air conditioning systems, plumbing services, piping and controls, off-site construction, monitoring of power usage, temperature, pressure, humidity and airflow, fire protection, design, engineering, integration, installation, and startup of MEP and related systems in new buildings, renovation, expansion, maintenance, monitoring, repair, and replacement of MEP systems in existing buildings. These services cater to various clients including building owners and developers, general contractors, architects, consulting engineers, and property managers in the commercial, industrial, and institutional markets. The stock price of Comfort Systems USA Inc. has skyrocketed by over 100% in the past year due to its consistent pattern of strong financial performance. Key factors contributing to this remarkable growth include exceptional quarterly earnings reports, growing backlog and strong demand for its services, strategic acquisitions, and positive analyst sentiment. Comfort Systems USA has consistently reported record-breaking earnings, with net income more than doubling from the previous year in several quarters. Revenue growth has also been substantial, with a 35.2% increase in the third quarter of 2025 beating forecasts. The company's backlog has reached an all-time high, indicating robust future demand for its services. The acquisition of 2 electrical firms in western Michigan and southern Florida is expected to add over $200 million in annual revenue and contribute an additional $15 million to $20 million in annual EBITDA. Analysts have maintained a bullish stance on the company, with several upgrades and increased price targets over the past year. Overall, Comfort Systems USA's strong financial performance, growing backlog, strategic acquisitions, and positive analyst sentiment have all contributed to its remarkable stock price growth. The primary drivers of revenue growth for the company can be attributed to several key factors. Firstly, an increase in service maintenance agreements and higher demand for construction services due to lien rights have contributed significantly to revenue growth. Additionally, growing core revenue-producing activities, vendor rebate programs, estimated fees from contracts, new construction projects, and acquisitions have all played a role. Notably, the acquisition of Fay & Zylstra Holdings, LLC and Masner Electric, Inc., is expected to contribute annual revenues of approximately $150–175 million. Same-store revenue growth has also been impressive at 33.3%. These factors have collectively driven revenue growth, with new construction projects experiencing a significant increase of 65.2% in 2025. On the other hand, the primary drivers of revenue decline are more limited. A decrease in billed and unbilled accounts receivable, as well as inventories, has contributed to revenue decline. Furthermore, the electrical segment has experienced a decline in revenue, with a significant drop of -26.1% in 2025. Net income and profit margins experienced significant changes between 2024 and 2025. Net income increased by a substantial +83.6%, rising from $376,563 to $691,752 over the 9 months ended September 30, 2025. This growth can be attributed to various factors. Profit margins also underwent notable shifts. The gross profit margin improved from 72.3% in 2024 to 74.1% in 2025, indicating a slight increase in profitability. However, operating income margin decreased from -0.07% in 2024 to -0.02% in 2025. Segment-wise analysis reveals that both the mechanical and electrical segments experienced declines in profit margins. The mechanical segment's profit margins dropped from 24.3% to 15.7%, while the electrical segment's profit margins decreased from 26.4% to 16.9%. The overall profit margins for the business segments also showed a decline, with the mechanical segment decreasing from 14.2% in 2023 to 12.5% in 2024, and the electrical segment dropping from 11.9% in 2023 to 10.8% in 2024. In contrast, the gross profit margin saw an increase, rising from 21.1% in Q3 2024 to 24.8% in Q3 2025, and from 20.2% in 9 million 2024 to 23.6% in 9 million 2025. The company's financial performance indicates a steady increase in its ability to generate positive operating cash flow. The data from page 12 shows that the net cash provided by operating activities has risen from $638,594 in 2024 to $717,816 in 2025. This significant growth demonstrates the company's improved efficiency and profitability, ultimately leading to a stronger financial position. The company's financial health has undergone significant changes in the past year. A notable increase in total liabilities from $3,006,412 to $3,544,465 indicates a substantial rise in debt levels. Furthermore, the outstanding balance of $35.3 million as of September 30, 2025, also suggests an upward trend. Moreover, interest expenses have seen a considerable surge, with a 100% increase from $6,692,000 to $13,467,000 in the 9 months ended 2025. This significant jump is attributed to various factors, such as writing off unamortized costs and amortizing financing and professional costs. The quarterly interest expense for Q3 2025 also witnessed a 71.9% increase from 2024. Overall, both debt levels and interest expenses have experienced substantial increases, indicating a concerning trend in the company's financial health. The company's financial performance reveals a stark contrast between its two business segments. The mechanical segment excelled, boasting a significant 25.5% revenue growth and accounting for 73.9% of the company's total revenue. In contrast, the electrical segment struggled, with a relatively lower revenue growth rate of 71.4%, although still higher than the mechanical segment. This disparity is further highlighted by the electrical segment's smaller share of total revenue at 26.1%. Management is optimistic about the company's outlook, citing strong market conditions driving revenue growth. They expect high demand from manufacturing and technology customers to persist through 2026, but anticipate continued supply chain constraints and labor cost pressures. The company is focused on generating free cash flow, maintaining a strong balance sheet, and returning value to shareholders through share repurchases. With favorable credit facility terms until 2030, management believes the company is well-positioned for long-term success. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has paid out $47,674 in 2025 and $30,322 in 2024. Additionally, it has also engaged in share repurchases, with a cumulative total of 10.8 million shares bought back as of September 30, 2025. Concerns about inventory buildup or supply chain disruption are evident throughout the financial summary. Delays in delivery of certain materials and equipment, pages 34 and 39, have led to increased labor costs due to supply chain shortages. Furthermore, shortages of labor and specialty building materials, along with rising material costs, have exacerbated these issues, page 44. These disruptions pose significant challenges for businesses, including difficulty obtaining bonding and insurance and delays in customer payments. That concludes the financial summary for Comfort SYST EMS USA Inc. Feel free to comment below, and I will be happy to answer them when possible.